Talk more about the sell-off with our panel. Joining us now is Vital Knowledge founder Adam Crisafulli and Raymond James chief market strategist Matt Orton. Guys, welcome. Matt, utilities and enterprise software both got hammered in today's session. So is this the beginning, you think, of a new mindset in the market with high rates, or is this just the typical last week of September before a Q4 rebound?
Hey, John, good to see you as always. And I would describe the market as going through a process of normalization. I mean, the market has been offsides literally throughout this entire year of pushing back against the narrative of the Fed that rates are going to have to remain higher for longer. And we have a pretty benign, good enough, I would say, economic environment. And as a result, I think the market and investors are finally starting to get that message. But what I've been reminding our clients is that we haven't had a 5% plus pullback since SVB in early March of this year. It's been a really, really long uptrend for this market, and investors really should be opportunistic because the economy is still, I'd say, in good enough shape. And what we're seeing is that there's a lot of opportunities for those who actually want to look and do their homework. Valuations are compelling in a lot of parts of the market. So I've recently, for the past couple of months, have been very favorable on energy. I think that still makes sense. And what investors should lean into going forward is quality, because real rates are going higher. That was probably the most hawkish message from the Fed. And so you want to own profitability. You want to own stronger balance sheets. Healthcare also provides a lot of that. Energy checks a lot of those boxes, and lean into some of the mega trends that we're seeing, such as investment in CapEx, reshoring. A lot of that goes to some parts of the industrials complex, and a lot of those parts of the market are cheap. So I think we're getting to the point where it makes sense to start buying the dip. Okay.
Adam, want to get your thoughts on this because, yes, I mean, the major averages, the S&P, the NASDAQ, on track for the worst month of the year. The Russell 2000's on track for the worst month since September of last year. There's definitely seasonality at play here. And yet, if you look at some of the places that have been hit the hardest, it's some of the most economically sensitive, right? It's been small caps, it's been mid caps, it's been banks, it's been transports, it's been retail. You have seen industrials roll over as well. Is the market pricing in the possibility of recession? And I realize I'm asking that ironically, since we just saw so many price targets revised higher because of stronger economic growth.
No, you're getting a lot of mixed signals right now. Just taking a step back and looking at the landscape since the Fed on Wednesday, you haven't seen really any movement in the funds rate forecast, either for the end of this year or the end of next year. So the Fed's been coming under a lot of criticism, or people have been complaining about the Fed being excessively hawkish. But you haven't seen funds rate forecasts move at all really in the market. And then on treasuries, you've seen kind of this pretty dramatic steepening in the curve where the long end yields are moving up. It's usually indicative of better macro sentiment. But at the same time, like you just mentioned, I think in equities, there's a lot of anxiety that you're going to start to see a more pronounced slowdown in economic momentum for a variety of reasons. The biggest one is just the lag effect of prior monetary tightening. And then you have kind of all these one-off issues with excess savings being extinguished, you have student loan payments, you have elevated gas prices, shutdown risk. So you have a lot of kind of mixed signals and cross currents. I think the biggest problem right now is we're just in this vacuum. We're in a vacuum of liquidity. This is a very poor seasonal time, like you mentioned, towards the end of Q3, the end of September. We're in a vacuum of news also. We're waiting for this inflation number, these inflation figures on Friday. You get a huge Eurozone CPI and you get the big US PCE in the morning. And that's really going to be the next major catalyst since the Fed on Wednesday. Since Wednesday, we've kind of all just been flailing around waiting for some type of confirmation to either refute or confirm Powell's message about rates and higher for longer. And that doesn't come until Friday. And then just one last comment on the shutdown. I don't think markets are all that concerned about the government of the shutdown. The only exception being, if there is a shutdown, we're going to have to wait longer to get the September economic data. So the September jobs report next Friday, and then the September CPI in about a week and a half. So if the shutdown does happen, those numbers will be deferred, and that's going to kind of just create more anxiety in the market.